Today we're going to strip away the mythology. We're going to talk about taxes and whether your assets are protected or whether you just think they are. This is the difference between having a legal entity and having a legal strategy. Most people treat their LLC like a decorative sticker on their business card. They pay the filing fee, get their certificate, and assume they're protected. So here's the problem. The words limited liability company on a piece of paper don't mean anything if you don't understand which version you built. If you're running a single member LLC, the IRS sees your business the way a mechanic sees a car with the hood welded shut. They don't look inside, they just tax you directly. But if you're running a multi-member LLC, you're suddenly in partnership territory. K1s, basis tracking, debt allocation rules, and a completely different liability profile. Most business owners don't know which structure they need until they're already bleeding money in taxes or staring at a lawsuit they thought they were protected from. And then there's negative basis. If your LLC goes underwater and you don't know how the rules differ between a single member LLC and a multi-member structure, you could be writing off losses the IRS will reverse in an audit, with penalties and interest attached. So today we're going to strip away the mythology. We're going to talk about taxes, what actually happens when your basis goes negative, and whether your assets are protected or whether you just think they are. This is the difference between having a legal entity and having a legal strategy. The LLC is a container, not a shield. Before we get into the differences, we need to agree on what an LLC actually is, because most people get this wrong from day one. LLC is not a magic force field. It's not a suit of armor. It's better understood as a legal container. Think of it like a bucket. You pour your business assets in: cash, equipment, real estate, intellectual property, and the bucket keeps those assets structurally separate from your personal assets. If someone sues the business, they typically have to reach into the bucket to satisfy the claim. They don't automatically get to raid your personal bank account or your house. But here's where it gets interesting. The IRS doesn't automatically care about your bucket. What the IRS cares about is how many people own the bucket, because that single fact, one owner versus two or more, determines every tax rule that applies to you. So the LLC is just the vessel. The tax treatment and the liability protection are determined entirely by who's holding it and how many hands are on the handle. If you're the only owner of your LLC, the IRS treats your business as a disregarded entity. This is a very specific term, and it matters. Disregarded means the IRS looks right through your LLC as if it doesn't exist for tax purposes. You don't file a separate federal tax return for the LLC. Instead, all the income and expenses flow directly on your personal return, typically Schedule C, if it's an active trade or business. You report the revenue, you deduct the expenses, and you pay income tax plus self-employment tax on the net profit. Now, a lot of people hear disregarded and think informal. That's a mistake. The entity is still very real for legal purposes. It still provides the liability separation we talked about. But from a tax standpoint, you and the business are the same organism. A single member LLC is like a captain steering his own ship. He's the only decision maker. He takes on all the risk. If the ship makes money, it flows directly into his pocket. If the ship sinks, his personal assets might be protected from the ship's creditors, but only if he maintained the separation properly, which we'll get to later. Key takeaway for single member LLCs: simplicity on the surface, but no complexity to hide behind if you mess up your records, your basis, or your liability formalities. Add one more owner, just one. Suddenly, everything changes. A multi-member LLC is treated as a partnership for federal tax purposes by default. That means the LLC itself files an information return, Form 1065, but it doesn't pay federal income tax directly. Instead, the LLC issues a Schedule K1 to each member. The K1 reports each member's distributive share of income, losses, deductions, and credits. Each member then reports their K1 amounts on their personal return. But here's where the complexity starts. A partnership can allocate income and losses in ways a disregarded entity cannot. Provided those allocations have substantial economic effect, a single member LLC can't split income with a partner because there is no partner. A multi-member LLC can structure distributions, guaranteed payments, and profit allocation based on the operating agreement. Think of it this way. If a single member LLC is a solo captain, a multi-member LLC is a band. And every band needs a contract. In this case, the operating agreement that defines who gets what, who decides what, and what happens when someone wants out. Without that contract, your state's default partnership statutes apply. And I promise you, your state's default rules are not written for your specific situation. So the multi-member LLC gives you flexibility, but it demands governance. You don't get the complexity without the paperwork. Let's talk about the tax differences in practice, because this is where entrepreneurs either save money or set themselves up for a nasty surprise. In a single member LLC, your net profit is subject to both ordinary income tax and self-employment tax. That's roughly 15.3% on the first chunk of your earnings. And it hits your Schedule C income automatically. There's no separate paycheck, no withholding mechanism built into the entity itself. You either make quarterly estimated payments or you face underpayment penalties. In a multi-member LLC, the tax picture fragments. Members who receive guaranteed payments for services pay self-employment tax on those guaranteed payments, but their distributive share of partnership income may or may not be subject to self-employment tax, depending on whether they're a limited partner or materially participating in the business. The IRS has been tightening this area, but the flexibility still exists. More importantly, a partnership can make special allocations. If one member contributes cash and another contributes appreciating property, or if members agree to allocate losses differently than profits, the partnership agreement can reflect that, provided it passes the substantial economic effect test. A single member LLC has no one to allocate with. It's just you and your tax bracket. A single-member LLC is simple but rigid. A multi-member LLC is complex but flexible. If you're using an LLC for real estate, for example, that partnership flexibility might be exactly what you need to allocate depreciation and losses efficiently. If you're a solo consultant adding a phantom partner just to chase tax benefits, that's a terrible idea. Now let's get into the topic most people avoid until it's too late: negative basis. This is where the single-member and multi-member structures diverge in ways that can absolutely wreck you in an audit. First, let's define basis simply. Your basis in an LLC is your economic stake, what you've put in, plus what you've earned and left in the business, minus what you've taken out. Basis matters because it determines how much loss you can deduct and whether a distribution is taxable. In a single-member LLC, because the entity is disregarded, basis is tracked at the owner level. You start with your contributions. Your basis increases by the LLC's taxable income. It decreases by distributions and losses. But here's the critical point. Business debts of the LLC do not increase your basis unless you are personally liable for them. If the LLC borrows money in its own name and you do not personally guarantee it, the debt does not give you basis. But what happens when losses exceed your basis? You cannot deduct the excess. The losses are suspended. They don't disappear. They wait until you have enough basis to absorb them. You cannot have negative basis in a single-member LLC. Your basis bottoms out at zero. Any further distributions beyond zero basis are treated as capital gain. Any suspended losses stay on the shelf. Now watch what happens when we add a second member. In a multi-member LLC treated as a partnership, each member tracks their own outside basis. And crucially, each member's basis includes their share of the LLC's liabilities. Recourse debt is allocated to the member who bears the economic risk of loss. Non-recourse debt is allocated accordingly to partnership rules, often tied to profit-sharing ratios or Section 704B regulations. This means debt can create basis for partners in a multi-member LLC in ways that simply don't apply to a single-member owner. If the LLC takes on leverage, the members may get basis in. This means debt can create basis for partners in a multi-member LLC in ways that simply don't apply to a single-member owner. If the LLC takes on leverage, the members may get basis increases that let them deduct more losses. But the reverse is also true. If the LLC pays down debt, or if a partner's share of debt decreases, their basis drops. And if distributions or losses push a partner's basis towards zero, the same suspension rules apply. Here's the punchline. Negative basis isn't really a thing in either structure in the literal sense. The IRS doesn't let your tax basis go below zero. But in a multi-member LLC, the interplay of debt allocation, distributions, and loss pass-throughs create far more opportunities to accidentally overdeduct. If you're a single-member LLC owner, your basis calculation is narrower, but cleaner. If you're a multi-member LLC partner and you're not tracking your basis annually, including your share of liabilities, you're flying blind. Finally, let's address the reason most people form an LLC in the first place: asset protection. Because this is where the single-member versus multi-member distinction gets genuinely controversial. In theory, both structures provide the same core protection. If someone sues the LLC for a business debt or liability, they can generally only reach the assets inside the LLC. Your personal assets, your house, your brokerage account, your savings should be off limits, provided you haven't pierced the corporate veil. But what happens when the lawsuit goes the other direction? What if someone sues you personally? A car accident, a personal guarantee, a divorce, and tries to grab your LLC interest to satisfy the judgment. This is where charging orders come in. A charging order is a creditor's remedy. Instead of taking over your LLC's interest directly, the creditor gets a lien against your distributions. They stand at the gate and wait for the money to come out. They don't get to vote. They don't get to manage. They just get paid if and when the LLC makes distributions to you. In many states, multi-member LLCs enjoy strong charging order protection. The idea is that the creditor shouldn't be allowed to disrupt the business and harm the innocent members. But some states treat single-member LLCs differently because there are no innocent co-owners to protect. Courts in certain jurisdictions have allowed creditors to foreclose on single-member LLC interest or even seize the underlying assets. Think of it like this. A multi-member LLC is a castle with multiple kings. If one king has personal trouble, the creditor is stuck outside the castle walls, waiting for distributions to drip through the gate. A single-member LLC is a castle with one king. In some states, if that king gets into personal trouble, the creditor can simply walk in and take the keys, because there's no one else inside to protect. That distinction has driven a lot of estate planning and business structuring. Some owners add a second member, often a spouse or a trust, specifically to strengthen charging order protection. That comes with real tax and governance consequences. You now have a partnership return. You now have fiduciary duties and potential disputes you didn't have before. And regardless of whether you're a single member or multi-member, if you commingle funds, ignore the operating agreement, or fail to maintain corporate formalities, a court can pierce the veil and ignore the LLC entirely. The structure doesn't protect you if you don't respect the structure. So, on asset protection, a multi-member LLC generally offers strong protection against personal creditors in many states, but only if the operating agreement is well drafted and the formalities are maintained. A single-member LLC is simpler, but potentially more vulnerable to personal creditors depending on your jurisdiction. In either case, the LLC is a tool, not a guarantee. So which one should you choose? Here's how to actually think about it. If you're a solo operator, you have no need for partnership allocations, and your primary goal is simplicity. Single-member LLC is usually the right starting point. You get liability separation, disregarded tax treatment, and minimal compliance overhead. But you need to understand its limitations. No special allocations, potential vulnerability to personal creditors in some states, and no partner to share the economic burden. If you have co-investors, if you need to allocate losses or profits asymmetrically, or if you're operating in a state where charging order protection from multi-member LLCs is materially stronger, the multi-member structure is worth the complexity. But you need an operating agreement drafted by someone who knows what they're doing, not a template from the internet, not your cousin who took a business law class. A real agreement that addresses capital accounts, tax allocations, exit rights, and deadlock provisions. The wrong choice isn't fatal, but it's expensive to fix. Converting from a single member to a multi-member is doable, but it triggers tax events and legal restructuring you could have avoided with proper planning on day one. If you're watching this and realizing your current structure might not match your actual risk profile, it's not a failure. It's an opportunity to fix it before it costs you. At Numeratus, we build financial architecture, not just filings. If you need your LLC structure, basis tracking, or asset protection strategy reviewed against how you're operating, we can help. Because having an LLC is easy. Having the right LLC for the right reasons, with the right documentation, that's what separates a business owner from someone who just pays an annual fee to the Secretary of State.